Karan, I've got two reports. One is upgrade. The second one is price target has been maintained. Post Zomato, do you think in the near term the stock deserves a re-rating?
Hi, good morning. I think from Zomato's standpoint, it is a very good execution as far as profitability is concerned. If you look at the contribution per order in terms of number, we are now somewhere approaching towards the peak of pandemic levels, right? It was around 20, 21 rupees that time on a per order basis. So from a profitability standpoint, there are levers around take rates, there are levers, around discounting basically coming down, and also the marketing revenue that they would make. But the problem here is in terms of growth rates. I think the re-rating for the stock will only come if the growth rates, sustain beyond that 20% kind of a number. And if you look at this quarter specifically, the growth rates were about 12% on GOV. Obviously, the two reasons for that. One is, the shutdown in 225 cities that they had. And second reason was also the inflationary pressure and also the overall QSR industry kind of struggling to grow as compared to what they were last year because of inflationary issues. So I think if the growth rates, on a steady state, sustain the range of 20-25% with healthy improvement in profitability, only then, we could see some sort of re-rating. But if growth rates are, 15%, 18% kind of a number, I think, there'll be no re-rating on the stock and the stock will be in the narrow band from now.
What do you make of the drop which has happened in the GOV? I mean, one side, Zomato was always a promise of growth and the fact that Indians will order more food and it is going to be food delivery business which will see exponential growth. That core growth now seems to be getting challenged and it's happened for 2 quarters on the trot now.
Yes, absolutely. I think, if you look at there's a base implication here. So if you have to really chase profitability, you need levers, right? Now, there is no lever in terms of average order value because that's the biggest lever. So India as a market is price sensitive, low order value nature. So once you expand, you see a reduction in terms of order value. So I think what they are doing right now is that they're not focusing in too much of expansion. They're not focusing in terms of driving a large sort of a new customer base. The bigger lever here right now is retention and increased frequency, right? So I think that's the risk here. So if you actually only focus on existing customer and drive frequency within them, you will actually not see growth rates which are superior 20-25%. Second thing also you have to look at is that the performance of the QSR companies. So many of these QSR companies right now in terms of SSG growth rates, the numbers have come down from the range of 7-8% towards 4-5% for some of these companies. So they are clearly seeing pressure. We are seeing a scenario wherein the base has kind of reached a respectable level, and even the delivery SSG, for some of these chains like Westlife and KFC, which were very small in the pre-COVID era. Now in the post-COVID era, for most of these companies, 35% of the revenues does come from delivery. So I think there is a catch-up which is playing out. There is a base impact here. And there's a clear dilemma for a company like Zomato whether to chase profitability or whether to chase growth. And that's the point here. So valuations right now are at 40 times EV/EBITDA F25, but potentially can it move to 50 times? That really depends on two reasons. One is of course the growth rates coming to 25% plus kind of number, and second is profitability. Now again in terms of profitability, they have done a very good job. Execution has been phenomenal. But going ahead, what are the levers, right? I mean, I don't foresee take rates increasing by a big margin. And how much can you pull discounts? If you keep pulling discounts, you're going to see an impact in terms of growth rate. So I think any kind of indication of take rates seeing a blanket increase across the chains and growth rates being 25% plus are the triggers for re-rating here.
Karan, we were just chatting before you came on board as to how Swiggy is actually seeing markdowns, but here you have Zomato, where at least it seems that the worst is behind. Would you then upgrade your price target or at least keep it on your radar for Zomato?
I think I would not upgrade it for now. It would keep it as a hold because the primary reason here is that, of course, one is most of these companies have seen a markdown in valuations, and that's primarily do with the growth, right? I mean, most of these companies in terms of growth rates were around 30, 35, even 40%, and on a normal state. Now it's come to more than 20, 25% kind of a range. So there's a clear issue in terms of growth. So I don't see any potential for re-rating. Plus, I think if you look at Zomato, there's also this issue of Blinkit, right? The quick commerce segment today is making a hefty loss. I think 800,000 crores is the annual EBITDA loss is what they are making. So you also have to monitor in terms of where the losses are heading because the core food business might look reasonably attractive at 40 times EV/EBITDA. But once you include the losses of this business, your valuations go, 53 times EV/EBITDA. So that makes it expensive. So I think I'll also monitor in terms of what happens to Blinkit, what is the kind of turnaround they are doing there. The kind of numbers they are doing right now, it's at a very small scale, about 40 million orders, which is very small. So one can't gauge in terms of what is the actual path to profitability here.
All right, appreciate your time, Tarun, and thank you for joining us.